India Bonds presents CNBC TV 18, India's Fixed Income Summit.
Why India Inc. is turning to bond markets. For the longest time, we have known that bank financing remained a default mode for the companies, but we really seem to be moving on for long-term sustainable capital requirements of companies. And Sadaf, let me start with you on that one. For a company like yours, which is into microfinance business, first of all, how are you approaching bond markets? And do you think a mix of equity and debt is something that the industry needs to be working on from here?
First of all, thank you very much for inviting me here. And Manisha, it's a very important topic. I think as far as institution like us is concerned and NBFC industry is concerned, the primary reason for accessing bond market is essentially focusing on diversification of sources of capital. Banks have supported us till now, and I think banks play a very important role in terms of providing finances for us to lend to the end customer. But increasingly, we are focusing on diversification of funds. So in that kind of our effort, bond market plays an important role. It not only helps us in diversifying, it also helps us in ensuring that our ALM is better. Because typically bank funding is coterminous to what loans we originate. But bond financing could be longer tenor, and it allows us a little bit of flexibility and allows us to negotiate better. So it helps in a multiple ways. It's a longer tenor. So from that perspective also, you can have an asset generation which could be a longer tenor. So it really helps. I think the most important aspect as far as the market is concerned right now, the interest rate transmission in bond market is slightly faster as compared to the banking channel. So I think that also in a declining interest rate scenario, it works well, that you can reduce your cost of fund by accessing the bond market and issuing bonds there. So that is the primary reason there.
Sachin, this one is to you. And then, NBFCs are increasingly seeing diversification, especially for a liability management as a criteria. How would you approach bond markets?
Good evening to all, and thanks for having me around. Yeah, I mean, historically, if you look at NBFCs were bank funded, and over the last, I would say, 1.5 decades, you have seen NBFCs moving towards capital market, and prior to what we saw in 2018 post ILFS DHFL thing, you had better rated NBFCs having larger concentration of capital markets as compared to banks. And obviously, the reasons that Sadaf was mentioning was playing out. We did see a contraction of that happening post 2018, 19 and COVID, where again banks became dominant. Obviously, what happened in 18-19 and the fact that, I think the overall limit for which SEBI had for NBFCs, mutual funds to especially invest in NBFC papers was brought down, and that also played an impact at that point of time. However, I think over the last few quarters, from 2023 onwards, we have again seen bonds, kind of picking up. In our own case, what has worked good for us during the same period has been the fact that, we had a 2-notch upgrade which came in. So now what we were in 22, 23 or AA minus, we moved up to AA plus. So that has also helped us in, beefing up our NCD and other instruments on the capital market issuances, and that has helped us in diversifying. Also, I think philosophically for NBFCs particularly in the erstwhile period, it was all about efficient liability management, was all about getting it at the lowest cost. I think that has moved over the period, especially we have seen what happened in 2008-9. One external event, credit crisis. You had NBFCs dominant on short term, but deploying long term, going for a toss, and you almost had 5 to 6 months of no funding happening from NBFC. Then you again saw the repeat of that in 18-19. Because of the domestic, issues of ILFS and DHFL, again, NBFCs who were high on short term, had to kind of, take a breather in between, and so I think, it's kind of, learnings are there, in that sense, and given the asset class focus each one of us have, I think, not only from a diversity perspective, but also from a ALM perspective, we have better flexibility when you look at it from a capital market perspective to match off your liabilities to your assets as compared to what, here I'm primarily comparing it with bank funding. So, that has kind of helped us, and I feel this, what we are seeing, the trend of diversity getting created and more, issuance is happening, especially from NBFCs, would kind of continue as we go forward.
So while, of course, the markets are, or the companies are looking at both ways in sense of financing, and that is exactly what they see going forward as well. Preeti, this one is to you. Over the last few years, when you look at the overall market, structures like REITs and InvITs seem to be expanding when you look at financing, especially in real estate and other sectors as well. How have you seen this grow? Where do you see the gaps? And where do you see the way forward from here?
Right. Good evening, everyone, and thank you for having me here. So obviously, historically, we had equity, we had debt. And there was one gap which was lying between the two. That's the gap which REITs actually have, REITs and InvITs have bridged. So this is one instrument which is giving you, in a way, the best of both worlds. So it's giving you regular income as well as growth. And if you look at the history, it's been a short history. It's not too long. It's been about 7 years since REITs have happened and maybe 9 years since InvITs have happened. So within the 8 to 9 years, I think it's gained considerable traction. Today, if you see the assets which are being managed between the two instruments, it's almost up of 10 lakh crore. So that's the feat we've achieved in the last 10 years. Even in terms of returns, people kept telling us, when we actually go and talk to equity investors, say, oh, the returns don't compare. And when we go to debt investors, then debt investors say, oh, there is too much of equity kind of risk. So that's a battle which we kept fighting all the time. But now if you see, this is one instrument which will mean moderate risk, moderate return. And I think 15% plus return over the last 6 years on an average across the REITs has been, I think, a considerable feat. I think, and this is one instrument since we are talking about in terms of the placement also. If you see today, we have mutual funds, insurance, pension funds. Everybody has invested in these instruments. And it has come across various funds, balance funds, debt funds, equity funds. So this one instrument which has actually fitted well in every bucket. Even from a debt perspective, when we talk of the funds, these are, construed as high yield debt products, to some extent. So to that extent, you have actually money coming in from debt and credit funds also. Balance funds, obviously, we match. Equity funds take us because we are a hedge against volatility. So in a way, we've been ticking all the
right boxes there.
Yeah.
Okay. The other thing, Preeti, that our market talks a lot is about the fair pricing of these bonds, especially when it comes to green bonds, whether that, of course, if they're ticking all the boxes in sense of ECG and governance, etc.
Yes.
But when you talk about the pricing of it, how far have we come on that?
So I think today, if you look at most of the REITs, historically, when we started off, all of us had bank funding at the SPV level. So we are a two-tier structure. All the funding started with bank. But if you see now the way it is progressed, most of the funding has now moved from the SPVs to the REIT through bonds. So today, if I were to give, say, Mindspace as an example, when we got listed, we had 4,000 crore of SPV level bank funding. Today, we have a 13,000 crore book, of which 9,000 is bonds, and 4,000 still remains at the SPV level. In terms of pricing, there's clearly almost, I would say, 50 to 75 bips gap between what we get at the SPV level versus what we get. Of course, keeping some aberrative periods aside, but otherwise, that's the kind of pricing. And as our co-panelist said, flexibility is something which we have also realized in terms of raising funds. Of course, we've done a lot of green funding also, so that's also been an added advantage. But overall, we've seen a lot of flexibility and a larger, I would say, avenues, because we have pension funds, mutual funds, NBFCs, everybody investing into these bonds. So I think that's really helped the industry.
Sharma, this one is to you then. How would you look at the retail participation coming into this space now? Because that is something we've been talking about. It's small right now, but the OBPs clearly do help that. How are you looking at the growing NCD appetite, issuer activity across all of these sectors?
I think we are a deposit-taking NBFC, and we have seen largely retail deposits, which is sizable. If awareness is there, there is no reason why retail investors will not put in money in bonds. Mr. Mittal was talking about rural India, Bharat participation. We are getting our deposits largely from the tier 3, tier 4 towns. So there is no reason, if the awareness is there, if credibility is established. As of now, what we see is even the large investors, be it funds, be it insurance companies, they are averse to lower rated instrument. In that scenario, to anticipate and expect retail investors to invest in lower rated instruments will be a challenge. But yes, if the rating is good, we should reach out, and there is no reason. If the awareness is there, retail investors will not put in money. For them, as Mr. Mithil was putting it, others have also put it, if you are able to get a better return than what you get in bank deposit, there is no reason why they will not participate. There are challenges. You need to have demat account, you need to be getting information on various platforms is available, scattered information. Challenges are there. But if the deposit is an indication, there is no reason why bond investment should not come from retail market at all.
So would you say that the corporate bond market is finally entering a more mature structural area from here on?
I think the sheer volume of overall corporate bond market, and slowly, we see on a daily basis, on a month-on-month basis, the participation of retail which is coming through. There is no reason in next 2-3 years it will be a very different scenario altogether. We have been talking about deepening market. I think if we look around, then we talk about different countries, what efforts they have taken, be it partial guarantee, be it liquidity providing, be it bank supporting in some other countries. I think there is no reason why India should also not be able to evaluate that. It should be definitely possible.
All right. So next 2 to 3 years, perhaps we could be looking at bigger numbers. But that's exactly the question I want to ask all of you. Sadaf, what's your sense? Retail participation and the corporate bond market maturing. How would you look at both of these? And what's your sense, as Sharma said, next 2-3 years perhaps is a better number that we can aim for?
No, absolutely. I think our bond market is evolving. Of course, the size compared to US, we are pretty nascent stage, but 59 trillion rupees is not a small sum. Year on year, like last year being around 13.7 trillion, and prior to that around 14 trillion bond issuance. It's a good number, sizable number. But I think the crux of the problem is on the secondary market. I think primary market, there is enough interest we have seen. Retail is coming in. I think private placement is predominant participation right now. Retail needs to come a little bit more. Retail issuance is 9,000 to 10,000 crores. I think that is to come. Plus, I think the most important part is the liquidity and the secondary market. That is very, very important. I think as compared to other developed economies where around 40 billion worth of money gets exchanged on a daily basis, I think that is where I think our market is lacking. But not to say that we are far away from that. We can do that to the extent of our size. I think there are few important steps that we need to take, and I think Mithil Saab also alluded to that. There has to be awareness and education of the customer. Bond should not be only merely especially from a retail participation, and when we are talking about dealing with Bharat, there has to be understanding of the risk, the credit risk that is with the kind of the product that is there, liquidity risk that is there, interest rate risk that is there, and like overall issuer risk that is there. That has to be understood first completely. Secondly, I think the most important aspect is rate should not be the only kind of a reason for determining A bond from B bond. I think you should look at risk adjusted rates, and then you should decide on what bond you should subscribe to. The third most important thing is transparency. I think it is from the issuer side also. We had a panel where municipal bonds are also coming in. So I think the more structural and information that is available to the people who are participating in the bond market, more would be the confidence and more they would be trading. I think it's in the interest of the entire market that there is greater transparency, greater understanding of the risk associated with bond. I think if that happens, definitely our secondary market will evolve faster. I see that happening, as my colleague said here, in next 2-3 years, because as we see the new generation which is coming in, they have a more risk appetite and they will be able to participate in this segment a little bit more.
How would you look at the retail participation? And do you think it is the younger generation participating better? I mean, I don't agree with that, but what's your sense?
Yeah, I mean, if you look at it, all the important indicators, like, for example, if you look at bonds, typically in India is still a AA above rated papers, right? You don't see anything below that. And with that, whatever yields that you get, and again, if one has to look at it from a fixed income perspective and equate it to, say, deposits, it's better than what you can get as far as bank deposits is concerned. Second, obviously, younger generation is more tax aware, and obviously, beyond a certain limit and a tenor, it comes under a long-term capital gains rather than fixed deposit interest getting into a normal tax slab. So that again, kind of is a plus. And over a period, we have also seen that the literacy levels on this side has gone up. So bond is not seen as an unknown kind of an instrument anymore, and that's what possibly is driving the retail participation, which is considerably going up. We have also seen issuances going up. Earlier bond issuances used to be with some few blue chips in each of the segments. Now, last year we saw almost 1,900 bond issuances. So issuances, numbers are going up, and with that, the overall subscription, you have also seen retail subscription, moving pretty fast in many of the bond issuance. So these are all very clear indicators that, it is becoming a valued, investment, opportunity is how that's been looked at. But the issues that both, Pradeep and Sadaf mentioned in terms of secondary, market, most of the retail investors, I think, still would be holding it up to maturity for liquidity to come in. So that is something which possibly needs to change. And our macros in terms of relative to GDP, we are still much away from even our South Asian peers as compared to Libya and the developed countries. So these are all things which I feel, the momentum has started, and you'll see this picking up. And the way we have seen, even as it rightly pointed out, the investor education part of it, and that literacy part of it becomes very important. We have clearly seen how the AMFI campaign on mutual funds has a correlation to how SIP investments have gone up. So something similar, and here I feel it is more incumbent on issuers like us, a responsibility coming in to have that education and transparency built up, will go a long way in terms of the retail participation numbers picking up going forward.
Preeti, what's your sense? And also, from being a niche lending segment to where it stands right now, would you still call it niche, or do you think it's evolving better than that?
So I think it is clearly evolving. Even if you look at the numbers, obviously retail participation has been very poor. Out of the total issuances, just about 2% is coming from retail. Otherwise, it's largely institutional participation. But at least if you look at the statistics in H1 FY26, that 2% actually moved to 5%. So that's almost more than double the growth. I think, as everybody said, awareness is going to be very critical. Transparency, which of course SEBI regulations over the last couple of years also have evolved in terms of the transparency disclosures. That's also helping. Recently, even last year in 24, they reduced the size of investment from 1 lakh to 10,000. Now, all of those are positive steps which I believe going forward should help. And I think from an economic perspective also, it's very critical that you have savings getting channelized into bonds, because that's also healthy for the economy as well.
Sadaf, we seem to be talking about tokenization and derivatives right now. We're calling it niche even as it is evolving. And of course, as you said, there's way more awareness, way more transparency that is still needed. Are we ready for the newer products?
Yes and no. I think, of course, innovation is needed because you need to kind of cater to demand of different types of investor, definitely, and the products that are available globally, derivative, the swaps that are available. I think if they are there, it makes the product more affordable for a lot of people. But at the same time, I think at the basic level, if we need to widen the market and broaden the market, I think then education is first step, and then of course broadening and going to innovative stuff. I think I'll again go back to one of the stuff that Mithil sir said, and we are talking about Bharat participating into the bond. Microfinance, which I represent as an organization, fundamentally started from SHG savings. So the self-help group first saves the money and then it lends to its members. So that is the way it is. So they have the nature of saving. And if you look at the amount of money that is lying in Jan Dhan account, almost 3 trillion rupees, so they have the money to save. I think if that can be channelized somehow into the bond market, which is relatively safer in terms of less riskier. So definitely it can help bond market to mature. I think to answer to your question, innovation, yes. Awareness, maybe more priority.
That perhaps goes hand in hand. But your final comments really, how would you look at the bond markets from here on, let's say next 10 years, and what would you say needs, very, very strongly on a priority perhaps to get there?
I think priorities are well set. Retail participation has to come in. Diversity of rating should be well accepted, and investors should look at different rated the way it has been done in US. If US bond market of AAA is less than 5% and it is more for lesser rated instrument, that is how it should phase out. That is how countries should adopt to the bond market. And we are very positive. I think there has to be innovation. To the retail investors, don't complicate, as what he is saying is right. Give them a vanilla product. As and when it matures, acceptability is better, then only look at innovations.
I was having a conversation last year perhaps, and this was about Indian participants know more about crypto and less about bonds. Is that about to change?
Can you just repeat it, what you said right now?
I said a lot of conversations that I was having last year with a lot of investors said that Indian investors know more about crypto than about bonds. Is that about to change?
No, my thought goes back to what Sadaf was saying, and also Pradeep. I echo that same. You need to get the basics right, and have the coverage coming in. There are a lot of investment which can happen in the tier 3, tier 4, and therefore not getting into crypto derivatives, etc. Keep it simple. Broad basis, the country has a potential to do that, and then kind of move up the value chain would be my thought process on this.
Preeti, your final comments on this. And the statement, by the way, was sent by the SEBI chief.
So I think today if we see bond market is largely limited to AAA, AA issuances. I think that needs to correct. We need larger access there. And I think the most other important thing is liquidity. That Mr. Muthoot also said that. So I think that those are some of the key things which need to be addressed. Market making, of course, is going to help. So I think once these are done, you'll create more depth in the market, which is, I think, need of the hour.
All right. Thank you so much, gentlemen, and the lady for joining in. So clearly we are here to grow. The markets look very ripe for new products and more new participation as well. It's about awareness, going to Bharat, and clearly keeping our governance and transparency on. Thank you so much for your time. Thank you.
India Bonds presents CNBC TV 18, India's Fixed Income Summit.